Intermediate Accounting, Chapter 2, Conceptual Framework Underlying Financial Reporting. Chapter 2, Conceptual Framework Underlying Financial Reporting. After studying this chapter, you should be able to 1. Indicate the usefulness and describe the main components of a conceptual framework for financial reporting. 2. Identify the qualitative characteristics of accounting information. 3. Define the basic elements of financial statements. 4. Describe the foundational principles of accounting. 5. Explain the factors that contribute to choices and/or bias in financial reporting decisions. 6. Discuss current trends in standard setting for the conceptual framework. Conceptual framework underlying financial reporting. Conceptual framework. Rationale for conceptual framework. Development of the conceptual framework. Information asymmetry revised. Objectives of financial reporting. Qualitative characteristics of useful information. Elements of financial statements. Foundational principles. Recognition, derecognition, measurement, presentation, and disclosure. Financial reporting issues. Principles-based approach, financial engineering, fraudulent financial reporting. IFRS-ASPE, looking ahead. Conceptual framework 1 of 3. Coherent system of interrelated objectives and fundamentals that are the foundation for developing standards and rules. A conceptual framework is needed to 1. Create standards based on established concepts. 2. Provide assistance in solving new and emerging practical problems. 3. Increase users' understanding of and confidence in financial reporting. And 4. Enhance comparability among different companies' financial statements. Conceptual framework 2 of 3. Objectives of financial reporting is the first level, the why goals and purposes of accounting. Qualitative characteristics of accounting information, elements of financial statements, second level, bridge between levels 1 and 3, foundational principles. Third level, the how implementation. First level, the building blocks identifies goals and purposes. Second level, characteristics that make accounting information useful. Third level, principles used in establishing and applying accounting standards. Conceptual framework 3 of 3. New framework by IASB in March 2018, effective January 1st, 2020. It deals with objective of general purpose financial reporting, qualitative characteristics of useful information, financial statements and the reporting entity, elements of the financial statements, recognition, derecognition, measurement, presentation and disclosure, concepts of capital and capital maintenance. Conceptual framework does not override specific IFRS. Objective of financial reporting. The overall objective of financial reporting is to communicate information that is 1. Useful to users, example, investors, creditors, etc., and 2. Useful in making decisions about how to allocate resources. Resource allocation decisions are assumed to include assessment of management stewardship, that is, how well management is using entity resources to create and sustain value. General purpose financial statements, basic statements that give information that meets the needs of key users. Fundamental qualitative characteristics 1 of 3. There are 2 fundamental qualitative characteristics. 1. Relevance. Information that makes a difference in decision making, has predictive and feedback confirmatory value. Materiality. Includes all material information that makes a difference to the decision maker. Consider impact on any sensitive numbers. qualitative factors must be considered. Fundamental qualitative characteristics 2 of 3. 2. Representational faithfulness. Economic substance over legal form. Transparency, representing economic reality. Completeness, include all pertinent information. Neutrality, information does not favor one interested party over another. Neutrality in standard setting. Freedom from error, reliability, management must make estimates and use judgment. Fundamental qualitative characteristics 3 of 3. To ensure information has relevance and representational faithfulness, follow 3 steps. 1. Identify the economic event or transaction. 2. Identify the type of information that would be relevant and can be faithfully represented. 3. Assess whether the information is available, cost versus benefit. Enhancing qualitative characteristics. 1. Comparability. Information is measured and reported in a similar way, company to company and year to year. Aids in making resource allocation decisions. Verifiability. Knowledgeable, independent users achieve similar results. Timeliness. Understandability. Allows users with reasonable knowledge to understand the information, presented with sufficient quality and clarity. Trade-offs and cost versus benefit. Trade-offs. It is not always possible to have all fundamental and enhancing qualitative characteristics. Trade-offs happen when one qualitative characteristic is sacrificed for another. Cost-benefits relationship. Benefits of using the information should outweigh the costs of providing that information. Led to simpler standards for private entities. Elements of financial statements. The basic elements of financial statements are defined so users have a common understanding of the main items presented on the financial statements. Basic elements of financial statements include the following: assets, liabilities, equity, revenues and income, expenses, gains and losses. Elements of financial statements. Assets. Represent a present economic resource, a right to use an asset that produces economic benefit or that has the potential to produce economic benefits. Entity has control over that resource. Entity's ability to decide how to use the asset and receive economic benefits, legal ownership. Resource results from a past transaction or event. Includes tangibles and intangibles as well as contractual rights. The conceptual framework defines the asset as the right as opposed to the physical asset. Elements of financial statements. Liabilities. 1. They represent a present duty or responsibility. There is no practical ability to avoid them. May arise through contractual obligations or statutory requirements. Constructive obligations, the company acknowledges a potential economic burden. Equitable obligations arise from moral or ethical considerations. 2. Entity is obligated to transfer an economic resource. 3. Obligation results from a past transaction or event. Elements of financial statements. Equity. Residual interest that remains in an entity after deducting its liabilities from its assets, also known as net worth. Represents ownership interest. Normally consists of shares, retained earnings, and under IFRS, accumulated other comprehensive income. Elements of financial statements. Other. Element, revenues and income. ASPE, increases in economic resources which result from ordinary operations. IFRS, increases in assets or decreases in liabilities other than those relating to contributions from shareholders. Element, expenses. ASPE, decrease in economic resources that result from ordinary revenue-generating activities. IFRS, no distinction between ordinary revenue-generating activities and losses. Element, gains and losses. ASPE, increases and decreases in equity from an entity's peripheral or incidental transactions, except revenues and expenses and owner's activity. IFRS, revenues and gains are grouped together under income, and expenses and losses are grouped together under expenses. Items included in financial statements. IFRS, statement of financial performance or statement of profit and loss and statement of other comprehensive income. Other comprehensive income, which is OCI, includes all changes in equity except for net income and owner's investments and distributions. Comprehensive income includes net income and other comprehensive income. Under ASPE, you have the income statement and OCI does not exist. IFRS, statement of financial position. With ASPE, we call it a balance sheet. IFRS, statement of changes in shareholders' equity. Under ASPE, it's a statement of retained earnings. IFRS, statement of cash flows. ASPE, cash flow statement. Foundational principles 1 of 2. Foundational concepts and constraints help explain which, when, and how financial elements and events should be recognized, derecognized, measured, and presented and disclosed. They act as guidelines for developing rational responses to controversial financial reporting issues. Foundational principles also include assumptions. Foundational principles 2 of 2. Recognition and derecognition. 1. Economic entity assumption. 2. Control. 3. Revenue recognition and realization principles. 4. Matching principle. Measurement. 5. Periodicity assumption. 6. Monetary unit assumption. 7. Going concern assumption. 8. Historical cost principle. 9. Fair value principle and value in use. Presentation and disclosure. 10. Full disclosure principle. Recognition and derecognition 2 of 7. Recognition under new IFRS conceptual framework. Elements of financial statements are recognized when 1. They meet the definition of an element, for example, an asset. 2. They provide users with relevant information that faithfully represents the underlying transaction or event. No probability or measurement criteria. If there is significant uncertainty as to existence or measurement, or low probability of occurrence, information may not be useful anyway. Recognition, derecognition 3 of 7. The economic entity assumption, entity concept, means an economic activity can be identified with a particular unit of accountability, for example, a company, a division, or an individual. It's not necessarily a legal entity. Legal entities can be merged into an economic entity for financial reporting purposes, such as consolidated financial statements. Defining factor for an economic entity is who has control. Recognition, derecognition 4 of 7. 2. Control. Control is an important factor in determining entities to be consolidated and included in an economic entity. Criteria under IFRS. 1. Having power over investee. 2. Exposure or rights to variable returns from involvement with investee. And 3. Ability to use power over investee to affect amount of investors' returns. Criteria under ASPE. 1. Continuing power to determine strategic decisions without others. 2. Demonstrably distinct. Can the entity be unilaterally dissolved by the company? Do others have a more than 10% ownership interest? Recognition, derecognition 5 of 7. Revenue recognition principle, ASPE. Revenue is recognized when risks and rewards have passed or the earnings process is substantially complete. Revenue is measurable, and revenue is collectible, realized, or realizable. Revenues are realized when products, goods or services, merchandise, or assets are exchanged for cash or claims to cash. Recognition, derecognition, 6 of 7. 3. Revenue recognition principles, IFRS. Follows a 5-step approach. 1. Identify the contract with the customer. 2. Identify the performance obligations in the contract. 3. Determine the transaction price. 4. Allocate the price to each performance obligation. 5. Recognize revenue when each performance obligation is satisfied. Collectible revenues are recognized when control over goods and services passes to the customer. Balance sheet approach covered fully in Chapter 6. Recognition, derecognition, 7 of 7. 4. Matching principle. Expenses are matched with revenues that they produce. Illustrates a cause and effect relationship between money spent to earn revenues and the revenues themselves. If the expense benefits future periods and meets the definition of asset, it is recorded as an asset. This asset's cost is then systematically and rationally matched to future revenues through amortization and depreciation. Measurement, 1 of 9. All elements must be measurable to be recognized. Because of accrual accounting, measuring many elements of financial statements requires the use of estimates. Estimates give rise to uncertainty. Measurement uncertainty when a value cannot be objectively measured. Existence uncertainty. Does the asset or liability meet the recognition criteria? Outcome uncertainty. Difficulty in determining future outflows and inflows. Measurement, 2 of 9. Therefore, we must determine the level of uncertainty that is acceptable for recognition, use appropriate measurement tools, and disclose sufficient information to indicate and describe the uncertainty. Need to determine the measurement basis. Measurement basis must provide relevant information that faithfully represents the event. New IFRS CF specifies historical costs or current values. Current values, fair value, value in use, or current cost. Measurement, 3 of 9. Of the 10 foundational principles, 5 are associated with the measurement of an entity's resources. Periodicity assumptions. Economic activity of an entity can be divided into artificial time periods for reporting purposes. Most common 1 month, 1 quarter, and 1 year. For shorter time periods, more difficult to determine proper net income, i.e., it's more likely errors occur due to more estimates. With technology, investors want more online, real-time financial information to ensure relevant information. 6. Monetary unit assumption. Money is the common unit of measure of economic transactions. Use of a monetary unit is relevant, simple, and understandable, universally available and useful. In Canada and the United States, the dollar is assumed to remain relatively stable in value. Effects of inflation and deflation are ignored, i.e., price level change is ignored. Monetary unit is relevant only as long as it is assumed that quantitative data are useful in communicating economic information. Measurement, 5 of 9, 7, going concern assumption. Assumption that a business enterprise will continue to operate in the foreseeable future. There is an expectation of continuing long enough to meet their objectives and commitments. Management must look out at least 12 months from balance sheet date. If liquidation of the company is assumed to be likely, use liquidation accounting at net realizable value. Full disclosure is required of any material uncertainties of continuing as a going concern. Measurement, 6 of 9, historical cost principle. Transactions are measured at the amount of cash or equivalents paid or the fair value of initial transaction. Three basic assumptions of historical cost: represents a value at a point in time, results from a reciprocal exchange or a two-way exchange. Exchange includes an outside arm's length party. The initial recognition for non-financial assets record all costs incurred to get the asset ready for sale or if its intended use. For example, includes transportation and installation costs, also called laid down costs. Historical cost principle. Measurement is especially challenging for 1. Non-monetary transactions, as no cash or monetary consideration exchanged. 2. Non-monetary non-reciprocal transactions, for example, donations. 3. Related party transactions, not acting at arm's length, use exchange value or cost. In these types of situations, an attempt may be made to estimate the fair value. Measurement, 7 of 9. 8. Historical cost principle. Measurement is especially challenging for 1. Non-monetary transactions, as no cash or monetary consideration exchanged. 2. Non-monetary non-reciprocal transactions, for example, donations. 3. Related party transactions, not acting at arm's length, use exchange value or cost. In these types of situations, an attempt may be made to estimate the fair value. Applies also to short-term financial instruments, for example, bonds, notes, accounts payable, and receivables. Measurement, 8 of 9. 9. Fair value principle. Fair value has been defined under IFRS as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Fair value has been defined under ASPE as amount of consideration that would be agreed upon in an arm's length transaction between knowledgeable, willing parties who are under no compulsion to act. Does not refer to an orderly market, nor does it stipulate that the price is an exit price. Fair value option. Financial instruments are measured at fair value with gains and losses booked to income. Measurement, 9 of 9. 9. Fair value principle. Entry price equals the purchase price, or the market value. Value in use or fulfillment value equals the value to the entity, which is entity-specific value. Exit price equals selling price, which is market value. Fair value based on this, exit price. For subsequent remeasurement, trend is moving from a mixed valuation model to a market valuation model. Presentation and disclosure, 1 of 4. 10. Full disclosure principle. This is the only principle associated with the presentation and disclosure. Follow general practice of providing information that is important enough to influence an informed user's judgment and decisions. It is useful. Disclosed information should 1. Provide sufficient detail of the occurrence. 2. Be sufficiently condensed to remain understandable and appropriate in terms of costs of preparing and using it. Always a trade-off. Is it detailed enough? Is it condensed enough? Presentation and disclosure, 2 of 4. 10. Full disclosure principle. Disclosure may be made within the main body of the financial statements, or as notes to the financial statements, or as supplementary information, including management discussion and analysis, which is an MD&A. Full disclosure is not a substitute for proper accounting practice. Notes to financial statements are essential to understanding the enterprise's performance and position. New IFRS conceptual framework provides general guidance. 1. Entity-specific information over general information. 2. Duplication inhibits usefulness. Presentation and disclosure, 3 of 4. Management discussion and analysis. Management's explanation of the financial information and the significance of the information, 6 disclosure principles. 1. Provide a view through management's eyes. 2. Supplement and complement information in the financial statements. 3. Provide fair, complete, and balanced information that is material to decision makers. 4. Outline key trends, risks, and uncertainties that may affect the company in the future and provide information on the quality of earnings and cash flow. 5. Explain management's plan for long and short-term goals. 6. Be understandable, relevant, comparable, verifiable, timely. Presentation and disclosure 4 of 4. Management discussion and analysis. 5 key elements. 1. Core business. 2. Objectives and strategy. 3. Capability to deliver results. 4. Results and outlook. 5. Key performance measures and indicators. Under IFRS, there is a general trend towards increased disclosure to achieve greater transparency. Expanded conceptual framework. At the top, you have user orientation and needs, then objectives, then you have qualitative characteristics and elements, then you have your foundation principles. Financial reporting issues 1 of 3. IFRS and ASPE are principles-based. It means selecting and interpreting accounting principles and rules relies on application of professional judgment. Legally structuring transactions so that they may meet the company's financial reporting objectives while complying with GAAP is known as financial engineering. When pressures for reaching specific financial reporting objectives are high, risk of fraudulent financial reporting increases. Financial reporting issues 2 of 3. 1. Principles-based approach. IFRS and ASPE are principles-based, grounded in the conceptual framework. Benefits of this approach: consistency and flexibility. First, principles. Some think principles-based GAAP is too flexible. In the absence of specific GAAP guidance, policies should be developed through exercising professional judgment and applying the conceptual framework. Financial reporting issues 3 of 3. 2. Financial engineering. Process of legally structuring a business arrangement so that it meets the company's financial reporting objectives. Structured financing, creating instruments so the financial reporting objectives are within GAAP. Financial engineering could result in biased information, now viewed as a potential fraudulent activity. Fraudulent financial reporting, number 3. Changes in the economic or business environment could trigger manipulation of financial information. Negative influence of budgets may lead to inappropriate decisions. Weak internal controls and governance. Activity of IASB. March 2018 released new conceptual framework, working on the definition of materiality, applying materiality, development of a framework for disclosures. Upcoming primary financial statement project. The end.